Now, I'll be happy to introduce our two presenters. Mr. Martin has been a professional trader for 24 years. He's the author of The Inner Voice of Trading. He coaches traders online and in person using what he has learned over his career from his own teachers, including Ed Sequoia, Victor Sperandio, and Michael Marcus, who were featured in Jack Schwager's two books, Market Wizards and The New Market Wizards. Mr. Kaminski has traded the futures markets for over 30 years. He started at Refco, worked at Tudor Investment Corporation for nearly a decade, and recently worked at Infinium Capital Management. His goals for teaching traders includes how to determine the feasibility of a trade and how to isolate optimum levels for both entries and exits. Again, welcome, Michael and Scott. And Michael, now I will turn the webinar over to you.
Thanks, Tom. It's great to be here. It's also a great honor to work with Scott. He's fairly legendary in the community, and he's a good friend of mine. He's got a lot of wisdom. So I'm going to go through my slides fairly quickly and get to the meat on the bone here with Scott within 5 or 10 minutes. For one, you can connect. Let's see. There you go. We're on YouTube and Twitter, so if you have any questions or any follow-up at any time, after the webinar, you can follow up with me, and I'm usually good. I do my own follow-up, so you'll never get like an assistant. It's just me. The thing about having great entries and exits and sticking to them is that you can act consistently. Consistency is what's going to lead to great performance. Whenever you do anything with a great deal of discipline, it will enhance your confidence, and when you act from a place of confidence, you tend to perform better. And that's what everybody's looking for, especially allocators. They want to see consistency. Trading well is like being a professional baseball pitcher. It's about feeling consistency and not having 85 pitches like Trevor Bauer. So what you don't want to do is taking trades that you're not supposed to take and do take the ones that you should. Both processes there are integral to great trading. You don't want to be what I call in the no-flyer zone, where you're trying to trade off of StockTwits or CNBC or anything like that. You want to kind of have your own ethos, and you want to follow that day after day and repeat it day after day. Let's see. Can everyone hear me okay? If you can't, just type it in the box in the lower right corner.
We hear you well.
Okay, great. In building confidence, you don't end up having these hair trigger responses to kind of jump into a trade late. I work with some folks, and for some reason they have a system that they've either built or they've back tested using a simulator or CQG, or they've done it by hand, and for whatever reason they can't pull the trigger because they're in fear, they have self-doubt. So when you have confidence, you don't have that. You won't be afraid, because you know that if you want to act like a professional trader, losses are a part of the business, and that's the way it goes. I lose money. I lose money regularly, and that's the way it goes. If I don't like it, I don't have to trade. What Scott's going to walk you through a little bit later is his methodology that's really good for kind of weeding out the bad trades. At the end of the day, you want to find yourself day after day in things that we refer to as high expected value trades. Even if you're going to lose money once in a while, over the longer haul, over dozens and hundreds of trades, you want to put yourself in a spot where you have high expected value trades. Now, that's going to happen at night. You're going to do a lot of your research and preparation for the next day at nighttime. But make no mistake about it that you are the system. Your emotions are going to affect what you do. Trading is 80% psychological and emotional, and if you don't have a strong grasp of who you are, it doesn't matter what you know at all, and that's true in life. It has nothing to do with trading. And I wrote, a quote that I get a lot via email is that there are no external solutions to your internal issues. If you have self-doubt, or if you lack confidence, you have to conquer that first, because there is no magic bullet in trading that any teacher can teach you. All right? It's just not going to happen. Your emotions and your attitude affect your judgment and your intentions. That, in return, affects your behavior, and behavior predicts where you end up in life. Intentions equal results. So if you want to trade, you have to trade. You have to wake up in the morning, wherever you live, Maybe you're in a different time zone, but you have to be ready to go at 9:30 a.m. when the opening bell rings for stocks, and earlier for commodity futures. So Paul said something like this. Paul Tudor Jones said, that trading takes place basically in the evening when you're doing all your preparation, and that makes a lot of sense, right? Back in the day, from the Sun Tzu in The Art of War, he said, all wars are won before the battles are fought, and that's because the victorious warrior first wins and then seeks battle. You cannot come to the market and think about what you're going to do the day of. It puts you in a reactive mode. I don't care who you are or who you're working with. If you're acting or reacting, you're typically not coming from a place of strength. You have to be prepared. And one way that you do that is by entering stop orders. I'm a big fan of stops. I do not use mental stops at all. I have been stuck in trades. I've been locked in limit moves. I've had a lot of things happen that I've learned from. But one thing I do religiously is every day I have a list of orders that need to get moved around. It's like a wish list. And I enter my orders religiously above or below the market, and I'm always letting the market come to me. I'm never chasing the market because that puts you in a spot of desperation. If you're in a situation where you've missed a trade and now you can't take the pain of not being in it, you go chase the market, it's not going to work. It puts you in a spot of being very weak. And as a trader, the market's tough enough. You want to always be acting from a place of confidence and a place of strength. Keep in mind that good trading sometimes means no activity. You don't have to be sitting there double-clicking your mouse or banging on your hotkeys or whatever it is that you do that sounds macho. Sometimes, you should turn the screen off and go away for a day, all right? Because trading is a lot more than just the order entry. But when you do have to do it, forget market orders. Put your orders, let the market come to you. They're free. You don't have to it doesn't cost you anything. You're always in control. You don't want a revenge trade if you've taken a string of losses, big or small, or if you've missed a few signals, maybe the market opened above where you wanted to get in. That's trading. That's the way it goes. It's unfortunate, but it's kind of like, it's difficult, it's frustrating, but you have to process that frustration in a way that's healthy and not take it out on yourself or try to take it out of the market, because chances are you'll lose. You can enter those stops, good for the day or good till cancel. I tend to do it in a way that feels good for me, and that's every day. Even if I have to enter the same thing twice, it gives me discipline to do that, and I repeat that process, and if there's anything I'm addicted to, it's my discipline. All right? That's my edge, is that I have discipline that my peers don't. So as speculators, of course we want to make money. We've read the same books. We know that the market wizards, made enormous amounts of capital, but they didn't do that without playing or learning how to play superior defense, because, like I've written, your gains only look like gains to the extent that you can keep your losses small. And, Scott will parrot that same type of ethos, is that on any given day, you have to play superior defense. That in and of itself can give you a pretty good edge, especially when you're not exactly sure what you're doing and you're just starting. When you're just starting out, you must keep your losses small. When you're long, you can enter your protective sell stops below the current market value, and that will help minimize your losses. You put that in ahead of time so that if the market moves sharply against you, you get taken out very, very quickly. You don't have to react and try to put the order in a falling market. Now, if you've seen a big run-up and several percentage points, you don't want to take or have price targets, right? You're going to let the market do the work, because, as you know from reading your Phil Tetlock, human beings are absolutely horrible at best at making predictions. So what makes you think you're going to have a price target on a security? I mean, I think that's ridiculous. You put the stop order in below the market and trail it. This way, if the market moves against you, you'll get taken out. But you don't try to predict where the move is over. So you can use it to protect your unrealized gains when you're long. Also, if you happen to be short, you don't have to just enter a market order short. You can use a stop order below the market to enter the market short. Same way with buy stops. When you're short, you want to put a protective buy stop in just above the market so that if the thing rallies in your face, you're going to get taken out and offset the position. Keep in mind that when you're a commodity trader, you have unlimited loss potential, as you probably know, regardless of whether you're long and short. So stops really are a way of life. Likewise, if you see a real panic sell-off, you can trail that with a buy stop that rests just above or at a measured spot above the market so that if it does rally, it can take you out. And as a tool for breakout traders, they live by entering buy stops above the market at X period highs or lows to get in. And those are the 6 uses of stops. This is recorded so you can go over that. I would forget not only market orders, I would forget limit orders. As a rule, when you put in more qualifiers on your order, it makes it less liquid. And I find those things tend to be emotional band-aids. You want to put in stops when the stop price, when the price trades at or through your stop price, the market order, it becomes a market order and it gets filled accordingly, in order. When you have limits on it, you're saying that I want to get stopped at a certain price, but I need to take this price or better. It doesn't really work for you if the market's running away from you. Yes, you might get a superior price or at least have the intention of getting a superior price. There's no guarantee that it's going to come back, and in the meanwhile, you're losing a lot of money. So, kind of like a tongue-in-cheek Chinese proverb here. It's like if you have a hole in the boat, you don't drill a hole in the boat to, let the water out. You get out, period. And then at least you can think with a clear head while you're licking your wounds. You don't want to be in a situation where you have any remnant of a bad trade on. Now, Scott's going to get into some things now a little bit more specifically on how he does his research and gets prepared for the next couple of days. So at this point, I'm going to turn it over to Scott.
Thank you, Senator. Thank you, Michael. Just to confirm before I begin, can I be heard okay? Is everything fine?
Yep.
Okay. All right, so let's begin by talking about this discussion. This discussion is on entries and exits. And when you put on a trade, all trades have a beginning and an end. And the proper protocol is to make sure that you planned out that beginning and end. So no trade should really take place without clearly articulating and writing why you're going to implement a trade strategy, why that trade strategy has favorable probabilities to begin with. And you got to do detailed scenario planning. Now, the last firm I was with for 10 years, every single trader had to come in with a written plan, had to be in writing, had to be approved by the trade managers for that particular sector, and before that person was even allowed to trade. So, and we had remarkable numbers. So planning is essential and avoids the preoccupation with being right or wrong about the market. And more importantly, it avoids the trader from skewing their psychology to suit their perceptions of the market. Now, if you don't really have a plan in action and you're just caught up in the emotion at the moment, you could get caught up in the emotion of an idea before you've even planned out that idea. So therefore, once again, the idea of having scenario planning, developing best case scenarios, developing worst case scenarios is critically important. That's what keeps your emotions in check. And if you don't do it, you're most likely going to lose over long term. So once again, develop comprehensive scenarios before you act. That's what's going to put you in a position to try to make money and capitalize on the market movements, whether it's up or down. Now, we all have our own approaches and all tools and technologies that we utilize to evaluate the markets. The only thing I can say is it's important that you do have some tools that at least gives you some idea to explain the probabilities of success of a particular idea. So the best traders have some kind of refiners or enhancers they use to create the most favorable outcome. And they have a tendency to stalk an idea in the smallest time frame that will allow that idea to be pursued to reduce the risk. So one of the things that's really important, we need to know our downside first and foremost. After a trade is put on, then we have to kick into our monitoring protocols, and that's a form of risk control as well. So the best traders manage their risk from above and below the market, and they manage the reward to risk ratios on every long or short position. So learning how to manage your exits is very, very important and key to long-term success in this game. Now, I've been in this industry for a while. I've worked with traders all around the globe, and there seems to be some key areas that traders consistently lose. And if traders consistently fail, it's because either they have improper psychology, they have a lack of a comprehensive risk management protocol, they don't have a comprehensive planning process that they go through, they don't manage their exits properly. And probably one of the most detrimental aspects of trading is you don't have the ability to really qualify your edges. You don't know how to label your environment. You don't know what kind of environment you're competing in. And if you can't answer that question, then there's a probability you're going to implement the wrong strategy in the environment you're trading in. If you're using a counter-trend strategy in a strongly trending market with fuel, that's a losing strategy. On the other hand, if you're using a trending strategy in a market constrained by structure, that's a losing strategy. So we have to make sure that we understand the environment we're trading in, we understand the edges that create that environment, and then we implement our execution edges so that we can put ourselves in the best position to succeed. Now, one of the things that Paul is famous for saying, he said, if every trader focused more on what they could lose if they were wrong and less on what they could make if they were proven correct, there would be many more profitable traders. Having worked with Paul for almost 10 years, I can tell you that's absolutely true. He was not ambivalent about his losses, and when he did lose, he felt pain, and he felt that all the best traders felt some degree of pain and were not ambivalent about losing trades or losing downward cycles, and they would implement the protocols in place to try to prohibit that process from spiraling out of control. So when we talk about planning, and I open with an intro on planning, the objective is to really learn how to manage your trades from above and below the market. So if we're trying to get long the market, we want to try to manage our risk by managing below the market and implementing the proper stop protocols. But we also need to manage that long from above the market, and we need to have a process to identify reasonable target objectives that we can use to generate reward to risk ratios that are viable. No matter whether, if you're pursuing a short position, you've got to know where you're wrong above the market. That's going to be the point where you're going to be forced to liquidate. So it's important that you really evaluate the market, top down, left to right, and figure out where the key structural footprints of the market are and use those to try to lean against with stops. On a short position, you also need to have some way to develop realistic targets below the market so that you can then create and facilitate the process of defining reward to risk ratios. So now the whole concept of defining where you're going to get into a trade is done by your own personal tools and technologies that you utilize. And as I said, most traders have begun to create enhancers and refiners to help them really zero in on a potential entry zone. Now, for the purpose of this lecture, I'm going to use a 2 ATR stop as kind of a default strategy, and that will help clarify some of the things that we're going to focus on as we move forward. So some of the things that are important to extract from this particular lesson plan, you need to know that there are different stop exits and price targets that we can use when we're trying to plan for the markets. Michael already alluded to some of those techniques. You have to have some basic entry setups that we use to exploit opportunity, and as I said, most traders have created their own refiners and enhancers to define exactly where those levels are located. And then, as I alluded to earlier, you need to have a comprehensive trading plan to support your trading operations. So what are some of the different types of exits? Well, there's always the initial or provisional stop at point of entry. That might be using a key footprint in the marketplace. It might be using a structural level in the marketplace. It could be just using an ATR default stop, let's say a 2 ATR stop. or a 1 ATR stop from point of entry. Those are all different types of stops. Time stops are very important. I'm going to talk about those in length. Once the market starts moving in your favor, you have to have monitoring protocols to help you gauge the viability of a trade, and you also have to have the ability to trail the market. And so you have to have trailing stop protocols that will allow you to push the trade and push in the higher time frames and maximize the expectation of that particular trade. On the other side of the coin, we need to have targets. Now, I'm going to discuss money targets today. I'll discuss structural targets. I'll discuss ratio targets, volatility targets, time targets are another type of target that we need to think about. But you need to have some kind of target, and I'm going to give you a very simple process to come up with a realistic target that we can use. And that's important because ultimately you've got to figure out whether or not you have a 3-to-1 reward to risk ratio. If you don't have a minimum 3-to-1 reward to risk ratio, the best course of action is just to abandon the trade. So, to reiterate, we need to have a line in the sand. You have to have some kind of provisional stop point where you're going to define that that's absolutely the price level that's going to take you out. Well, you also have to manage the time aspects of the trade, and there's a certain window of opportunity, and it's typically 48 to 72 hours where you should start getting some positive feedback. Otherwise, the best course of action is to simply liquidate the trade and move on to the next trade. And then we got to push the trade and maximize the expectations of a winning trade by using some kind of trailing stop technique. So this first chart one, we're going to basically talk about structural stops. Now, the market that I decided to focus on for this particular presentation is Apple Computer. So on the far left of the chart, you'll see that we've got a buy breakout above the 78.43 high. And then you can see I've got these structural highs all above the market, and the market continues to make higher highs and higher lows above the market, and those blue ellipses are simply trailing stops that you use to stay with the trade, and if we did that, you can see that you're still long the market. Another type of stop technique is trailing moving average stops. Now, for a fast money player, they're going to likely use a 5-period or 9-period moving average. That's the orange moving average that we see on this chart. And you can see that the fast period moving average took you out several times. You can then use your tools and techniques to try to re-enter on a pullback. The shaded area just below the yellow moving average is the zone between the 20 and 30 period moving average. And I find that's a very important area. The volume weighted average price tends to be located in that zone. So I kind of shade that area on all my charts, and you can see that Apple actually pulled into that zone several times, found buyers, and reasserted itself to the upside. The 50 period moving average is a key institutional moving average, and I work with a large fund in New York to trade stocks, and they're very big believers in the power of the 50 period moving average as kind of their line in the sand. And if you look at this, you can see that using the 50 period moving average alone, you're still long Apple Computer from the breakout in the far left of the chart. Another technique are volatility-based stops. So at point of entry, you can default to a 2 ATR stop. And then you can trail a 2 ATR stop or a 3 ATR stop or 4 ATR stop. You can see that in this case, this is also Apple. And if we simply use a 2 ATR trailing stop from close, you didn't get stopped out of the chart till the middle of July. There's also other derivative ATR stop trailers. I have many clients that use a 5 ATR stop from peak. So for instance, when we put in the 95.05 high, you would have a 5 ATR stop below that peak, and every time you make a new high, you continue to move that ATR stop upward, and you finally got taken out of that trade just a couple weeks ago. Now, time stops are also very important. So, as I said, if you've done the planning process, you created viable scenarios, you know your best case, your worst case scenario, and you've put on a trade, one of the things that you got to think about is what are the performance characteristics of this trade that need to unfold in order to confirm whether or not the trade is viable. So typically I use a 48 to 72 hour window. If I'm failing to receive positive feedback within that window, I'll simply exit the trade and look to get back in. The rationale between time stops is it helps decrease risk and smooths out your overall equity curve. So I can tell you the very best traders have some kind of comprehensive monitoring protocol that they're going to implement as soon as the trade is initiated. And you're always looking for positive feedback. If you fail to get that positive feedback and you're getting non-confirmation, the best thing you can do is just liquidate the trade and move on to the next. On this particular trade, I've got rectangles where you could have implemented several types of trades. The second rectangle from the left, let's say we're buying a pullback and it starts going in our favor for a couple days, but then it backs off. You'd simply execute a time stop and then wait for either a breakout or an additional pullback. The third rectangle from the left, the market pulls back for 3 days, which is typically a decent buying opportunity, a 3-day pullback. If you purchase that pullback, you can see it rallied for 2 days, failed to initiate, simply execute a time stop, and the market went into a C leg down, had an additional deeper pullback, so you could have then tried the trade a second time. The fourth rectangle from the left is an opportunity to implement a time stop. When the market, this is an example of a breakout to new highs, it failed to initiate within a 3-day window, simply execute a time stop and then look for the next opportunity. Targets are very important. Targets are what we use to manage the trade from above the market in the situation of a long trade. Targets below the market are focal points for trying to manage below the market on a short trade. So there are several targets that I look at. Look at money targets, structural targets, which are really prior month, week, day highs and lows, prior swing highs or prior swing lows. Ratio targets, I've studied Elliott wave theory for 20 years. I've used ratio targets for my entire career. They're extremely viable and are part of my program. Volatility evaluation extremes, you can use historical volatility, implied volatilities, ADX targets, CCI targets, RSI, stochastic, whatever it may be. You're looking for sentiment extremes that may be utilized to liquidate trades. And then in order to push a winning trade that's giving us positive feedback and giving us flow structures that are viable, you have to have some kind of trailing stop technique. The next slide shows a simple 3-point process that I use to develop a meaningful target. So in this case, we get a strong move from A to point B. So I'm thinking in terms of a pullback. Once the market pulls back into that 20-30 EMA zone, I'm looking to establish a position with my particular tools. One of the targets that I'm first going to utilize is the prior high. So point B is a legitimate target. That's a decent structural target. Second target would be finding what the measured move is. So if I take distance AB, add it to point C, distance CD gives us a secondary target. And in a strong trend market, you'll tend to hit these measured move targets or even exceed them. If you take the midpoint between target 1 and target 2, that gives you a third target, which those become very viable targets and have a high probability of getting hit. So from that target price, we can then look at our entry price, our stop level, and our target, come up with a reward risk, And if it's at least 3 to 1 reward to risk, in many situations, you're going to have 5, 6, 7 to 1 reward to risk scenarios. With beginning traders, I really want them to get in the habit of liquidating trades and capturing profits. And so I have them implement a 2-for-1 type money management target system, which is all about capturing trades and getting the trade risk-free as soon as possible. So in this situation, if we bought the market at 100, put a stop, $5 stop in, and the market moves our way, which is our 1-to-1 target at 105, we could liquidate half our position, move a stop up to break even. Now we have a risk-free trade. So this is an approach that day traders use. This is an approach that many large traders use that I know of. And it's quite effective in learning to capture money, manage your risk, and control your equity curve. Chart 6 shows various ratio targets and some volatility targets. So if we took that breakout in the far left of the chart and we want to figure out ratios of the first leg up, you can see I've got a 50% target, 100% target, which actually stopped the market right up at the 95 level. The 1.618 target stopped the all-time high in Apple. So these are legitimate targets, and learning to incorporate ratio targets is very important. If you haven't studied Elliott wave theory, I recommend it. Not to get in the idiosyncrasies of trying to count waves and identify waves, but in a strong trending market with fuel, these are the type of techniques that we'll utilize and develop realistic target objectives. Also below, I've got a tool that helps you identify sentiment extremes. You can see when the market at 95.03, we hit the 100% price target. Simultaneously, we had sentiment extremes. So that becomes a very important point to liquidate your trade, or at least partial out the significant portion of it, and then look to reestablish on a pullback. Now, we talked about entries, and refining your entry is really up to your methodology. Everyone's got a core methodology that they're going to utilize to identify points of entry that have the highest probability of creating a successful outcome. But I think another component needs to be transition. If the market starts to, most people are trying to buy in a pullback, a traditional pullback, buying weakness or stalling strength. However, you have to have a transitional approach as well. And so if you fail to get that pullback or it doesn't pull back to the exact level that you had identified, the market begins to transition. You can look to enter with a transitional approach. An additional type of transition is a breakout transition. The market has a shallow pullback and then it presses above the past swing high. You can always enter on a breakout above that swing high. So that's a breakout transition. So the next chart, chart 7, shows different types of transitional entries. So the far left arrow shows a breakout transition. The second left arrow shows a secondary breakout transition. The 3 arrows that are pointing down have a simple stochastic. It shows very oversold scenarios into 3 areas that put in very important structural lows. So that's an example of pullback or buying on weakness. If the market fails to get to your level and begins to move away from that level, you can also look to get in on some kind of transition pattern with, whether it's a 3-bar transition. There's all kinds of tools that we can identify to jump in the trade, as long as it still has reward-to-risk ratios that are viable. So if we're going to maximize your reward relative to the risk, we have to do some thorough scenario planning, and more importantly, you have to be able to identify the edges that you're looking at, the environment you're looking at, to see whether or not that environment and the edges that you've identified are cooperating to create a viable scenario to begin with. So the thing that's really important is that when you're planning out your trade, structuring your trade, make sure it has a minimum of 3 to 1 reward to risk ratio prior to entry. Those ratios are important, those minimum ratios are important to help you define whether or not you should even pursue that trading. So chart 8 shows a couple trades. We've got 2 trade setups here that I've mapped out. On the left side, we have our initial run up. and then we pull back, have a fairly shallow pullback. So as I said before, we're going to default to a 2 ATR stop. So we've got our entry zone. We're going to default to a 2 ATR stop. The dash above that entry zone highlights the money target or the 1-for-1 target. And as I said earlier, if you hit the money target, you partial out half your trade, you move your stop up just below that swing low, you now have a risk-free trade. If we create our ratio targets, you can see that it did hit the 100% ratio targets, and those are extremely important. You can see on the far right of the chart, we also have a pullback type trade. And we get a pullback into a prior low, so we're buying against structure with a deeply oversold stochastic, which creates a favorable situation. And once again, you can enhance that entry zone by dropping down the lower time frames and really fine-tune your entry. And drilling down through time is a very important component of managing your risk. We default to a 2 ATR stop. That defines our money target above the market. Once again, the market hit the money target, partial out of half your trade, move your stop up to just below that swing low. You now have a break-even trade. And this market did run up to the measured move target, just fell just short of it. So in summary, what are some of the things I want to take away from this introductory lesson on exits and entries? Risk management is really key to your long-term success, so that's critically important. How much you bet is going to determine your successful position sizing is a very important component. You could create a whole lesson on position sizing. I can tell you that having worked with Paul, he very seldom risked more than 0.5% in any of his trades, so you don't have to risk a lot to make a lot of money in this business. I saw him make significant returns year in and year out without having to risk extraordinary amounts of money. Once the market does move in your favor, you have to have a strategy to push the trade, which is your trailing stop approach. But simultaneously, you have to have some tools and techniques to try to manage the trade and monetize the trade. And that entails using some techniques to trade around the overall core position, which would be trading volatility targets or sentiment extremes. Use those sentiment extremes to partial out of your position, look to reload on some kind of pullback. So there's different tools to manage your equity curve. But ultimately, you have to cultivate a healthy dose of respect for the risks inherent in the traded game. And one of the objectives of this lesson is to make sure that everyone's around the trade for another day. So I can't stress the importance of risk management. I can't stress the importance of having a 3-to-1 reward to risk ratio. Those are all crucial to your ultimate success in this game. Thank you.
We'll be happy to take some questions now. Thank you, Scott and Michael. We'll be happy to take some questions now. Is there an echo still? Okay. A question has come in. What are your thoughts about intraday trading?
You know, I don't want to do that much work for too little money. I tend to look at commodities like investments. I like to hold them for weeks and months at a clip and add to the position so I have, you know, something worthwhile. I too start with a very small piece so that I can lose it and not go nuts, following the Jim Rogers method, where he likes to say that he's a terrible trader. He says that because he's usually 2 months early to the move. And if I'm wrong, that's a lot of times where I'm wrong, is I'm too early. So I have a real small piece of risk on, but I like to add aggressively. In a case study that I do with the sugar move that I caught from, say, 10 to 21 back in 05, 06, you know, my margin to equity ratio was never less than 40, and it was often as high as 60 and in sugar. It didn't start that way. I built into it, but, you know, that's the way that I learned to trade, and it also fits my personality. So I'm not going to put in hours and hours of work to capture 6 points on the S&P. I'd rather go, I mean, Seattle has $15 minimum wage now. I can go up to Wendy's and make more money than day trading the S&P. Scott might have his own thoughts, but those are mine.
Well, I've been put in a unique situation where I worked at Tudor for almost a decade, and there they were really longer-term position traders and 2 to 3 day swing trading operations, and I mastered that 2 to 3 day window and did quite well. But when I came back to Chicago and I worked at Infinium Capital Management for almost a decade, they were heavily influenced in intraday trading, and so I was fortunate enough to be mentored by some very quality intraday traders and did learn how to trade with an intraday approach. And I actually like intraday trading, but I'm not talking about high-frequency intraday trading. I might do 1, at most 2 trades a day and call it a day, but it's not something that, the trade has to have great probabilities and expectation scenarios before I'm even going to take a trade. So sometimes 1 or 2, 3 days will pass by before that type of trade materializes again. So I do think that, I will say this, intraday trading requires an extraordinary amount of time and effort. Detailed planning needs to take place. So I typically spend 2 hours every evening mapping out the Dow and the S&P in great detail so that I can pursue some trades in the day time frame. But as I said, it's not high frequency day trading. I look for 1 or 2 very viable opportunities. If they don't present themselves, I won't even trade. But I typically get 5 or 6 of those a week, which are good. The thing about high-frequency day trading is you're competing against the Citadels, you're competing against the Getcos that have mainframes that fit into very large buildings. They've got high-speed cable, so you're trying to compete with people that have such a massive edge over you that I don't think that the typical trader can compete with those type of institutions, especially in a high-frequency setting. Hopefully that helps.
Thank you. Do you apply these concepts to trading Forex at all?
Yeah, I believe, in terms of, I spoke generally about using stops. They can be applied anywhere. I think the question is probably more targeted to Scott, though.
Yeah, all the techniques that I used when I was developing my approach, a couple of rules I had for myself. It had to be applicable every time frame in every market. And for most of my career, I've traded the global stock, bond, foreign exchange, future markets around the globe. So I've traded foreign exchange and precious metals heavily in the interbank market with the same degree of success as any other vehicle. So these approaches can definitely be used in foreign exchange. And foreign exchange is a great vehicle because it trends so well. When the market really starts to move, it can really move.
Thank you. What about trend lines? Do you use trend lines?
I do use trend lines, not heavily or aggressively. I have other approaches that I use to define trend and define support and resistance, but trend lines are a viable approach.
We have a question about I believe it was chart 28 that also had the sentiment indexes on it. Can you talk a bit more about the sentiment?
Well, that's one of my key focuses in my career, and that really emanates from work with Paul. Paul was huge into evaluating the sentiment and the flow structure of the market, and he paid very, very close attention to sentiment. And people in that level of sophistication and at that level of talent, they interact with all the other traders that are doing the same thing and all the other hedge funds, so they have a good idea how everyone's positioned. But Paul used to always say that I have to get in when everyone's getting out, and I have to get out when everyone's getting in. So gauging sentiment is critically important, and you have to train yourself to be a contrarian. When the market looks the absolute best, it's probably the worst time to enter a trade. You have to think in terms of waiting for some kind of pullback to create some more And therein lies the importance of a reward to risk ratio. If the market is screaming and it's compelling every cell in your nervous system to buy, it's probably not a good idea to buy. So it's important to have some kind of sentiment tool and technique that you can use to gauge the sentiment in the marketplace. And if it seems like it's a screaming buy, having a plan, going through your protocols, going through your daily checklist will help define whether or not that trade has a viable reward to risk setup. And I can tell you at sentiment extremes, it's very hard to find a 3-to-1 reward to risk ratio. You're probably lucky if you get 1-to-1 or less than 1-to-1. So having some kind of tool to evaluate sentiment is very, very important.
Okay, thank you. Do you consider adding to a winning position?
Well, that's the whole reason to get in, right? It's not about the first piece. If you're looking to, get in and then get out, again, you're trying to impose your will on something, and I don't believe we're smart enough. I know I'm not, and I know I've outread and outstudied most people. I have access to most people that the attendees have not, and even still, I think we're very, very bad at making predictions. So the goal for me anyway, the goal for the trader is to develop a system with which he's compatible, right? And so what's compatible for me is to take on some risk that I can live with in the short term with the intention of adding more and having a position that's going to matter. You can buy and sell and make small bits of capital, but over the long haul, you're just wasting time. You're killing years of your life, So I only want to take risks that are going to pay me, right? Who needs S&P style returns with futures? It doesn't make sense, right? I could just buy an index and leave it. So for me, it's absolutely part of the system, and it's integral to what I do to try to get as big as I can, as fast as I can, without being stupid, without making mistakes, and without doing any, real lasting damage to the portfolio. Scott, what do you think?
Yeah, I'm in total agreement. I think that for a long-term pull trader, adding to a position, and it's not something you do every single day, but you're waiting as the campaign unfolds. You're going to wait for important transition points to try to add to that position where you have a viable reward to risk ratio. Now, Paul used to look at every add-on as its own individual trade. So if he put on his first piece and it had a 3-to-1 reward to risk ratio, started to spiral in his favor, and then he looked to add to that position, he would go through the similar trading protocol and process and daily checklist to define the expectation and the edge with the trade. But he would look at that piece as having its own individual reward to risk ratio, and then he would manage that piece. And if it continued to spiral in his favor, the market continued to show fuel and positive trend metrics, then he would look to add at the next potential transition point. So that is the key to really, especially in this, I have many traders that I've mentored that trade stocks exclusively. And they've done very well by learning to add a key point in a campaign. So that is definitely a viable piece of a long campaign trader.
Do you have like a set percentage or amount of money you're going to risk, a set percentage of your portfolio amount or amount of money that you risk for any individual trade?
You read the stories of yesteryear, and some of the aggressive traders were putting on, say, 2 and 5% risk units. When the markets were less crowded, they could probably get away with that. These days, volatility spikes out of the blue, and that becomes very, very painful when you have, your initial risk unit on. So I like to start with 50 basis points and figure out how many contracts that is. Sometimes I'll cut the number of contracts in half and give it even more room, right, because there's that inverse relationship. So I'm willing to give the market a lot more room, but again, I'm not trading that first unit as the end all. It's really just the first part of a bigger campaign to put on some significant risk.
Well, I'm a strong believer in volatility adjusted risk. So there's 2 types of risk. You can either say, this is my entry point, this is my stop level, and if that's $1,000 of risk, let's say you've got $1,000 of risk, and that equates to 20 contracts, and that's your size. That's one alternative way to gauge risk. I have learned from the preeminent risk manager, Paul Jones, the importance of volatility adjusted risk, which means you look at the volatility of the marketplace and you think in terms of daily volatility, and you structure your quantity according to, number one, your capital base, and number two, the volatility of the market, and then come to a formula that creates quantity determinations. And typically, I don't risk more than 25, 50 basis points on any trade. And as I said, I worked with Paul. There was occasional opportunities where he went big, but the vast majority of his risk was well contained within 25 to 50 basis point realm. That's where you really need to be at to consistently succeed over a long durational period of time.
In fairness, though, Scott, you know, Paul was trading some monster size, right? 0.5% risk for him was not, you know, it was probably a couple hundred contracts. You know, these folks are going to be trading 2s and 5s, maybe 10s. So they might be forced because of their account size to trade smaller, which is a little trickier when you're trying to add risk. So speak to the attendee who's dealing with a limited capital base and doesn't have, you know, more than $1 billion under management.
But that's exactly the point I'm trying to make. Trading with volatility adjusted risk means that you're, by the very nature of volatility adjusted risk, you're trading small until you earn the right to trade larger. So you typically need to start trading more than 2 to 3 contracts. You typically need, you know, a $200,000, $300,000 account to really justify doing that. Now, these are my beliefs. There are plenty of people that have succeeded with dollar risk, and they've done quite well. I know Michael Marcus has done quite well doing that. I have just learned that if you want to stay in this game for the long haul, and one of the objectives of this lesson and discussion is to help traders be around to trade another day, trading smaller is much better than trading larger. So just because your stop point is at X and your entry point is at Y, and it says that your risk is, you know, $100, and so you put on 10 contracts. If some global catastrophic event happens and the market just spikes, there's no guarantee you're going to get stopped out at that small risk point. And I've seen it happen, and it's happened in my career many times, where the Bank of England decides to sell gold in the middle of the night, and I get stopped out $30 off my stop price. So you're better off to trade smaller than larger, and you're better off to wait until you get more money under management to trade larger.
We had a question about, you had mentioned the checklist, using a checklist, and are there any examples of your checklists available anywhere?
I have clients that I work with that I give the checklist to, but I don't really have anything available. I could work with Michael and put together a basic checklist that he can get out to people.
Thank you. What about trading options? Would you say that applying these same techniques would be appropriate in the options market?
Well, when I worked in Infinium Capital Management, that was a major option house, and they aggressively traded options. But I think the people that do best trading options are the market makers. Now, at Tudor, we traded options as well, but not frequently, only when we thought the market was at a major sentiment extreme and you could buy puts on the cheap or you could buy calls on the cheap in anticipation of a significant transition reversal. But I did work with option traders at Infinium every day, and I would sit down with them, go through my protocol, evaluate the market, and they would take that into account when devising their option strategy for the day. So yes, you can use these approaches to help you better manage your option positions.
On your choices of moving averages, do you have any kind of guidelines in terms of how you pick the period for the moving average?
Well, I've been fortunate enough to work with very large funds around the world. And for instance, the 50-period moving average is a very powerful institutional moving average. The 20-30 period moving average is something that I use quite regularly. Is a very important line in the sand zone for any trend. And the reason I use that zone is when I've looked at VWAP pricing, and I've got clients that I work with that might have to buy 200,000 shares, and it's all done electronically. So what they will do is they will go to their algo systems and say buy 200,000 shares every time it touches the VWAP price, and that volume weighted average price always tends to fall within that 20-30 EMA zone. So I think that's a very important zone that everyone should have on their chart. And if you could look at any major trend, when the market pulls back to that zone, especially after it's made a new high and it's pulling back, or it made a new low and it's pulling back, that becomes a very important zone to look for institutional trade to re-enter the marketplace. I think the 9-period moving average is a great fast period moving average to utilize, especially if you've got smaller capital bases and you can't sit through a significant downturn in the market. So that's a great way to stay with the trade. Once it gets taken out, that's a fast money exit that will get you out, and you don't then have to sit through a 20-30% pullback.
Thank you. We have a question regarding, go ahead.
And then, of course, the 200-period moving average everyone looks at is a basic, the hedge fund and the mutual funds look at 200-period moving averages as a major long-term trend filter.
Thank you. We have a question back to sentiment. Do you ever look at the commitment traders report for like the natural resource markets?
I looked at the commitment and trader reports when we had an individual specialize reading that report at Tudor, and he gave us great clues and great heads up. And I don't do it on my own because I don't have the skill set or the time to go through that, but I have seen people do quite well with it. So it's a very important component in trading futures.
And we had a question, more about Paul Tudor Jones' history, and I was just going to suggest that they could read Jack Schwager's Market Wizards, as he's featured in that book.
Absolutely, great resource. You could also Google him. He's got the largest philanthropic endeavor in New York City, Robin Hood Foundation. And I know 60 Minutes did a lengthy piece on Paul Jones and Robin Hood just a couple months ago, so you can look that up as well. But Google Paul, there's a wealth of information on him, and Market Wizards 1 has got a great dissertation from Paul.
Thank you. Michael, you'd mentioned, Ed Sequoia is one of your teachers. Can you kind of walk through like a entry and exit signal that might have been typical to Ed Sequoia approach?
Yeah, I mean, I cannot though. Our relationship is more of a friendship these days, and it's based on a lot of trust. So I don't really kiss and tell on that stuff. What I know, which is not terribly a lot, he would think of as an absolute betrayal. So I can't even go there. Sorry about that.
That's fine. To respect proprietary information. No problem with that. See, if X, I think you mentioned Elliott wave a lot. So you have studied and used Fibonacci ratios, correct?
I have, yeah. I use it extensively every day. I think it's a very, very powerful tool, but I need to reiterate, when you study Elliott wave theory, and I've got a dozen books in Elliott wave theory, many people put decades into trying to assign a wave pattern and wave count to every potential wave in the market. And that's not what I found, is that in strong trends that have fuel, that have phenomenal trend metrics associated with them, using Elliott waves are very powerful tools to give you target objectives that have a high reliability of getting hit. And so therefore you can structure realistic reward to risk ratios based upon those wave targets. Doesn't mean it's going to hit those wave targets. Sometimes it'll fall short. In a strong trend, it will greatly exceed it. And if it does exceed measured move targets, that just enhances the viability and the strength of that particular trend. If it falls short some wave targets, that's a sign that the trend is weakening. So you can also think in terms of another tool to evaluate the strength or weakness of a particular trend. But I think it's a very important component in trying to develop realistic target objectives in markets that really have strong fundamentals, strong fuel dynamics, and great trend metrics.
Okay, well, one last question, and then if you have any closing comments, we'll then end the webinar. So the last question is, can you recommend any books on money management?
Well, I think Reminiscence of the Stock Operator is a must-read for everyone, because that book entails all kinds of information on risk management. I know that if you go to Google, or if you go to Traders Press, and you just type in position sizing, there's half a dozen books that will pop up on position sizing and risk management. So I know there's optimal F formulas and optimal F books. There's books on volatility adjusted unit sizes. I can't recall specific titles off my head, but I know that they're out there. And that's a very important read, so I can't stress the importance. If I'm going to have some kind of closing remark, it's risk management is omnipotent. And I've always had success as a trader, and I was always able to make money, but it wasn't until I went to tutor for 10 years and learned the fine art and idiosyncrasies of managing risk that I was able to hold on to the money that I'm making. So incorporating a comprehensive risk management program is essential to long-term success in this industry.
And I just came to learn when I was younger that it's possible to have too little risk. You know, in order to trade, you absolutely have to have goals, daily goals, not just what instruments you want to trade. You know, with the big contracts, the mini contracts, that's all ego talking. So you find one that works for you, that fits with your psychology. But then you have to think about how much do you want to grow your money? What's worth your time? What are your financial goals? And I think a lot of traders, you know, are just happy to be trading in the markets and have a margin account open in the first place, which is great. That's certainly a step in the right direction. But then afterwards, you have to empower yourself and say, okay, I am doing this. I am entering my stops. I am taking the trades, and I'm not, you know, over trading. And here's what I need my money to do for me to make this worth my while.
Great. Well, thank you very much, Scott. Thank you very much, Michael, for a really nice presentation. We appreciate it, and I'm sure the audience appreciates it too. As we mentioned earlier on, this is a recorded webinar, and everyone who's registered will receive an email link to it. And again, thank you, everyone.
Thank you very much for putting this together, Tom and Michael.
Okay. And on me. Thanks a lot. Bye, everyone.
Bye.